What's going on, guys? Today I wanted to go over my favorite options trading strategy, which is the put credit spread. So I'm going to start by going over how I set up the trades, the different scenarios that you can run into while you have the trade on, and then finally go over some actual trades that I've put on and that I continue to put on over time. So sit back, relax, and enjoy the video. And if you do like the video, make sure you drop a like down below. And if you haven't yet, go ahead and hit the subscribe button as well. All right, so for a put credit spread, you can see here we have SPY, and this is the most liquid underlying. It's just the S&P 500. You're gonna kind of have your best bet on getting things filled and not have any problems with getting orders filled on SPY. So it's always good to trade a very liquid underlying. So if we zoom in here, we'll just do a quick example of what a put credit spread is. So right now you can see we're trading at 460. So let's say we want to sell a put here around the 450 mark. So we would sell a put right in here, and that would be at 450. So basically we're saying that we don't want the stock to go below 450, or we don't believe the stock is going to go below 450. And then you would buy a put. Let's just say we want to do $5 wide. So here is 445. So here we would buy a put right in here. I'm trying to get the line to level out there so we can see, right? So what we're saying is if the stock goes below 450, we will basically start losing money until it gets down to 445. So at 445 we'd suffer our max loss, and our max loss for a trade like this, right? We traded $5 wide, so it'd be $500 on this trade, because we're doing $5 wide times 100, $500. So that's what we're looking at there. So you can see basically, like I said, this trade, all we're saying is that we don't want the stock to go below 450 by whatever expiration date. So if we jump over to the trade tab, I'll actually show you kind of how to put this trade on. So what you can see over here, normally you have the options chain and it looks like this. So you have how many days you have till expiration here, and where I normally like to sit is around 45 days. So I kind of trade 30 to 45 days. Every once in a while I'll put a 60-day trade on, and that's just because if volatility is really low, I'll go out a little bit further in time to collect a little bit of extra premium. But other than that, I try and stick kind of 30 to 45 days. So we're at 46 days here on December 17th. So let's click on that and we'll scroll down here in the options thread. I have them all marked right now, so that's why there's so many options on here. You can see here where you kind of have this transition. That's where we're currently trading at. So you have your puts on this side and you have your calls over here on the left side. So what I always like to do is go to the probability of out of the money. So that's this column that I have here on my chart. And I like to go up to the 90% mark. That's where I kind of tend to like to sit normally. But for this trade, like I said, we were down here at 450. So this right here is saying that we have about a 62% chance of this trade being profitable. So that's kind of what we would look at here. So we would actually go here and sell. We would sell a vertical, which is a spread. And then you can see down here, we're selling the 450. And this one will want to change to 445. So there's 445. So for this trade, we would actually collect a credit of $106. So like I said, that's a very low probability, or lower probability. You still have a 60% chance of being profitable, which isn't bad at all. It's lower compared to what I would normally target, but you're collecting $100 on that trade. So you're you're risking 500 to collect 100. So what is that? A little over a 20% return, because you're at 106 here. So that's really good. I mean, for a month, right, you could make 20% on your money. So it's a high risk trade because you are a little bit closer to the money. You're only $10 out of the money here. So if you go and kind of look at the trades that I normally put on, like I said, I'll normally go around to the 90 mark. So here, kind of the 410 number, that looks very attractive to me. So I would go here, sell vertical, and right now it's giving me 5 cents, but that's because this is only $1 wide. So I'm gonna change this to 405. That's $5 wide. So I'm collecting $25. So obviously you give up a lot of premium, but you have a lot more security in this trade. So I make these trades all the time. Even if volatility is not crazy high, I'll still put some of these trades on and just keep buying power for if volatility spikes up. But this is just a real quick overview of how to put the trade on. So you're selling an option closer to the money and then buying a kind of insurance option a little further out of the money. So there are only really 3 things that can happen in the market, right? It can trade up, the market can trade upward, it can trade sideways, or it can trade down. And the benefit to this strategy is you can capitalize on all 3 of those structures, whether the market's trading up, down, or sideways. And what we've laid out here are kind of 3 example trades. So I've laid out kind of the start of the trade being the start of the line here, and then the end of the trade being here. So this would be expiration. So here you can see the price on this trade is kind of sitting in here. It's around 433, and we are saying that we sold a put down here at 430 and then bought a put down here at 425. So $5 wide in there, and you can see as the price kind of shoots up, we get less or further and further out of the money, and basically we can collect all of our premium. So here, if we had expiration here, we would have expired around 455, so $25 out of the money, and we would have collected our full premium. What they kind of say with this strategy, and kind of some data shows, is that you should try and collect close the trade at 50 to 75% of the profit. So if you collected $25 originally when you put the trade on, you would aim for around $12 to $13 collected to be at 50%. I tend to always try and collect a little bit more, so I actually end up taking it a little bit longer and going for around $3 to $4. And the reason you should take the trade off ahead of time is you can kind of keep your money working for you. So right when I put the trade on for 45 days, I'll collect $25, and by the time I have 15 to 20 days left, I'll only have $3 to $4 left in the trade, right? So it's a lot more lucrative to be taking the trade off at that point, put a new trade on, and just keep collecting money, basically. So like I said, this is a winning trade when the stock market's trading up. So here we're saying kind of the stock price is in and around here, which is around 435. We're saying that we sold a put spread around 425, sold the put at 425, and then bought our insurance put down here at 420. So as the market traded sideways kind of in throughout this time period, you're seeing that it never drop below. Obviously you want to build a little bit of insurance in here. These trades are very close to the money, so even this first one, I would normally trade a lot further out of the money than this. So what you're seeing here is kind of a very aggressive trading, but even when the market's trading sideways in here on this yellow trade, you're seeing that we expire out of the money down here at the end. So we're out of the money and we collect again our full premium. So here's where you run into problems. So this is a market, right? So we're seeing the market trade down. So this was again the month of September where we saw the market and everything kind of crash down, and we're kind of timing this as poorly as possible. So we're hitting basically the peak here, which is around 453, it looks like in there. And then we're saying that the trade, we only put it on to come off here. So we're having the trade come off kind of right in on this worst candle here, so at 431. So we sold a put originally, let's say at the 435, and then we bought our insurance put down here at 430. So when this happens, right, the trade is going against you, and basically if you let this trade go all the way to expiration, you would lose money on it. You would actually lose, let's say this is around 431.50, you would lose $3.50, so $350 on this trade. So you would lose that minus whatever you collected in premium. So if you collected 50 cents in premium on this, and then you ended up $3.50 in the money, you would only actually lose $300 because you keep your original premium on it. So in this situation, your best bet, especially, right, you see in here, as the market kind of crashed down, you would expect, right, volatility to increase. As the market crashes, volatility tends to expand and go up. So what I would do in this situation is, as the market's kind of dipping in here, if you've collected enough premium, take the trade off at this point, because you've received all this theta decay up to this point. Especially when the market bounces here, this would have been a perfect time to obviously take the trade off. Obviously, in retrospect, it's easy to say that, but if you get worried and you see even here when the market kind of turns around and you start having a couple bad days in here, it's still not a bad idea to either take the trade off before you incur kind of a significant loss, or what you can do is roll the trade. So you can normally roll these trades out in time and down in strike. So you might even be able to, right, I don't have the premiums and everything to be able to see, but let's say at this point in time, this spread is originally, let's say you were able to collect $50 for it, like we said. Let's say now it's worth $100. So you would be down, you'd be down $50, right? So 100 minus your original 50, you'd be down $50 on this trade. What you can do is go out in time, so let's say out to here, and down in strike, and if you can collect $100 on this trade, which is, like I said, a little bit further out in time and a little bit further out of the money, you could roll this trade out and down. And basically, if you can collect $100 on this trade, you're not going to lose money, right? So you collected your 100, you are at $100. It's going to cost you $100 to take this trade off. If you put this trade on for $100, basically you offset that loss. So you originally collected 50 when you put the trade on here. So minus 100, so you're actually minus 50 right now. So if you can basically roll this trade down and out for $50 or more, then you are $50, you're at break even. Anything more than that, you're still at profit. I always like to target, right, whatever I had to take this trade off for. So if I had to take this trade off for 100, I always try and target putting a new trade on for $100, because then at that point, right, these two trades are break even, but I'm still collecting my original premium, right? I'm just losing a little bit of extra time. So those are kind of ways to look at the trade and how to manage it. So let's get into just a couple trades that I've put on even in the last week or so. So here's an example of a trade that I've actually put on. I put this trade on yesterday, and it literally is almost a match, an exact match of the trade I showed you an example of earlier in the video. So it's December 17th. Like I said, that was 46 days out from today. And like I said, when I put this trade on yesterday, so it was 47 days out at that time. And we were looking at a strike price. So we sold a put at the $415 mark, and we bought a put here at the $410 mark, again for December 17th. And we were able to collect $26 on this trade. Like I said in the video, it was 25 when we just looked on Thinkorswim. So we've already decayed $1 off this trade. So we've already been able to collect $1 in just a day. So you can kind of see the math and see how it all works. And that's kind of how I implement the strategy there. And here we have a closing trade. So here we're buying to close, and this is a spread that I put on a month or so back, and we're seeing November 26th was the expiration date, and we bought to close a 385 put that we sold earlier, and then we had to sell to close a 380 put that we bought earlier. So in total, this only ran us $3 to close this trade. And like I said, I probably originally collected around $22 to $25. So I'm collecting almost $20 on this trade. So this is a strategy you can use on a small account, right? If you have $1,000, you could put 2 of these trades on, because you're only going to need $500 in collateral. You can even use this strategy with lower amounts of money. So you could change the width of your strikes to only $1. So you could have traded the 385 and 384 spread. So you can put it on and kind of adjust it to how you see fit, but I like going kind of far out of the money and using a larger spread, because I think it kind of benefits me in the long run. So I hope you enjoyed the video. If you did, drop a like down below. If you want to see more videos like it, make sure you subscribe. And if you have any video recommendations or anything that you want to see from the channel, just let me know in the comment section down below. But otherwise, you have a good rest of your day, and thanks for watching.